There are a lot of misconceptions out there about ETFs. One being that ETFs cause volatility. Some active managers are warning that the move towards passive investing in ETFs could pose a risk to the markets should ETF investors suddenly start to sell. But are they really a threat to the market, Doug? You've had to deal with this question for a long time.
We've heard this come out for over 25 years now. We've yet to see any problems with dislocation as a result of ETFs. We've had large volatility events. The last month has been historic volumes here on the floor. One of the misperceptions they say is, oh, well, if an ETF is trading, somehow that trade impacts the underlying security. But we just don't see it. The math doesn't prove it. Less than 10% of the ETF trades actually result in any kind of creation redemption activity where someone had to go and buy and sell the underlying security.
Yeah, what's amazing to me is we see all this, people say, wait till things get volatile, then you're going to see the whole ETF lie exposed. How much more volatile can we be in the last 3 months? And the ETF market and the overall market generally has functioned under a lot of pressure and functioned fairly well.
Well, and this idea that somehow ETFs are going to be the seller that drive things is exactly the opposite of what we've seen. You look over the last 6-7 months, we've seen huge outflows from actively managed equity mutual funds and all that money plowing into equity ETFs. ETF buyers have been the floor on this market, not the ceiling.
Yeah. We want to move on here. One of the things we're going to show you over the next few weeks is model ETF portfolios. We're not wedded to one. I'm not wedded to any of them. I just want to give you all a sense of how you could build a low-cost ETF. And I'm talking ultra low cost, so we turn to you for some advice on how to do this. And you set up one for us. It's got 1, 2, 3, 4, 5, 6 ETFs in it, and it's pretty well diversified. U.S. equities, you want to use that iShares Core S&P 500 symbol is ITOT. You've got a 40% weighting in that. Now, we can argue about the weighting.
Sure.
But the point is, what is this, 4 basis points?
So it's 5 basis points all in for this whole portfolio. ITOT, that iShares fund, that's sort of your equity anchor, is only 3 basis points. This is frankly the lowest cost portfolio of any kind you can put together. You can't put together a mutual fund portfolio, a separately managed account portfolio. You cannot beat it on cost.
And you, of course, you have international exposure here. You have the world x the U.S. That's the Spider S&P World. GWL is a symbol there, 30%. Again, we can quibble about the percentages here. Emerging markets, SPEM. Now, there are many emerging market ETFs, EEM included, but this is probably the lowest cost one.
11 basis points.
11 basis point. Okay. Bonds, aggregate bond index. That's the Schwab one you're using. Again, low cost.
Yep.
There's other ones that are out there. There's AGG too.
Yeah, but it's hard to beat 4 basis points for that kind of broad bond exposure. Equity, in corporates, treasuries, you name it.
Now, I was intrigued that you gave 5% each to 2 smaller asset classes: real estate and commodities. You have Schwab U.S. REIT here, which obviously owns real estate investment trusts in the United States, and Granite Shares Commodity, which owns a broad basket of commodity futures there, 5% weighting each of those.
Yeah, absolutely. I think most investors are underweight these alternative asset classes, if we want to call them that way. They're super cheap in an ETF wrapper. They do exactly what they say on the tin.
Doug, your thoughts?
I think it's interesting that someone who's followed this portfolio for a lot of years, seeing the diversity of names, it's really not just the big 3 players that are in this space. Charles Schwab ETFs brought in over $28 billion in net cash flow last year, and that's been 2018's story. We had 58 different issuers launch ETFs last year, 16 of which brand new to the industry. So it's about diversity and growth for the industry.
Well, the important thing is this isn't the last one or the first one. We're going to have many more of these model ETFs to show you how you can build a low-cost ETF portfolio. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Dave and to Doug for joining us today, and thank you for watching. You can find all of our latest videos right here on our website. That's etfedge.cnbc.com. And don't forget to follow us on Twitter at ETFEdgeCNBC. We'll see you next Monday, same time, same place. Have a good week.